The big lie of banks. How to protect and multiply your wealth. Have you ever stopped to think about the real value of your money? One of the biggest mistakes banks tell us is that the money we keep in our accounts is growing. The truth is that although bank account balances may increase due to interest, this does not mean that the real value of money is actually growing. With inflation soaring and bank interest rates lagging behind, keeping money in a bank account could actually be losing you money. In this video, we'll explore 6 types of assets that can stop wealth erosion and help you build lasting wealth for generations to come. 1. God's money: gold, silver, and platinum. Since ancient times, gold, silver, and platinum have been considered the pillars of monetary value. These precious metals are not only prized for their beauty and rarity, but also for their ability to preserve value over time. In a world where inflation can erode the purchasing power of money, these assets stand out as a safe and stable store of wealth. The intrinsic value of precious metals. One of the main reasons why gold, silver, and platinum are so highly valued is that they have an intrinsic value that goes beyond their monetary properties. These metals are scarce and their reserves are limited, making them a natural hedge against inflation and currency devaluation. Additionally, gold and silver have a long history of use as money and stores of value dating back thousands of years. They are physically durable and do not degrade over time, making them a reliable way to preserve wealth. The value of gold, for example, is widely recognized globally and has been a constant reference for the value of currencies since ancient times. Although the gold standard has been abandoned, gold continues to be an important store of value, especially in times of economic crisis or financial instability. Silver, in turn, has significant industrial applications in addition to its value as a precious metal. Platinum, with its extreme rarity and diverse applications in industrial and technological sectors, is equally important as an asset to protect against economic volatility. The impactful evolution of prices. The price of precious metals has demonstrated remarkable growth over the decades, reflecting their growing demand and their role as a hedge against inflation. For example, before the 1950s, an ounce of gold sold for around $400. With inflation and continued money printing by governments, the price of gold has skyrocketed to over $2,000 per ounce by 2023. Future projections suggest that the price of gold could reach $10,000 per ounce by 2032. This substantial increase in value demonstrates how gold can be an excellent long-term investment to protect and multiply wealth. In addition to gold, silver also showed significant appreciation. Historically, silver has been used in a variety of industries, from electronics manufacturing to the production of jewelry and utensils. With increasing demand for electronics and renewable technologies, the value of silver has been boosted, reflecting robust growth in recent years. Platinum, in turn, is a very rare metal and is widely used in automotive catalysts and in various industrial applications. Its scarcity and continued usefulness make it an attractive investment in times of economic uncertainty. 2. Industrial commodities: the demand for raw materials. In the world of finance and investment, industrial commodities play a crucial role, not only because of their importance in the global economy, but also as an efficient way of diversification and protection against inflation. Unlike precious metals, which are valued primarily for their rarity and intrinsic value, industrial commodities are valued for their practical utility and constant demand across various economic sectors. The importance of industrial commodities. Industrial commodities are raw materials that are transformed into finished products and used in a wide range of industries, from construction to the production of electronics and vehicles. These materials are essential for the manufacture of consumer goods and infrastructure, and their value is largely influenced by global industrial demand and fluctuations in supply markets. Among the most notable industrial commodities are copper, cobalt, nickel, and aluminum. Each of these raw materials has unique properties that make them indispensable for different applications. Copper. Copper is widely used in electrification and electronic components due to its excellent electrical conductivity. It is essential for the manufacture of wires, cables, and electrical circuits, and its demand has grown with the advancement of renewable technologies and the expansion of global electrical infrastructure. Cobalt. Cobalt is a rare metal used primarily in lithium-ion batteries, which are essential for portable electronic devices and electric vehicles. Rising demand for electric cars has driven demand for cobalt, making it an attractive investment for those seeking exposure to emerging technology trends. Nickel. Nickel is widely used in the production of stainless steel and in lithium-ion batteries. Its versatility and demand in diverse industrial sectors, such as construction and automotive, make it a valuable industrial commodity. Aluminum. Aluminum is lightweight and corrosion-resistant, making it ideal for aeronautics, construction, and packaging applications. Its use in various sectors reflects its importance and the constant demand for this metal. 3. Safe haven coins. In a financial world characterized by volatility and uncertainty, safe haven currencies play a key role as stable stores of value. These currencies are considered safe due to the economic and political stability of the issuing countries, making them an attractive option for investors seeking protection against market volatility and inflation. Let's explore the top safe haven currencies and why they are so valued. The paper of haven coins. Safe haven currencies are those that tend to maintain or even increase their value during periods of economic or geopolitical instability. They are seen as a safe way to preserve capital, especially when other currencies or assets are facing significant depreciation. The stability of these currencies is generally supported by strong economies, stable political systems, and sound monetary policies. Top haven currencies. 1. Swiss franc, CHF. The Swiss franc is widely recognized as one of the most reliable safe haven currencies in the world. Switzerland, with its tradition of political neutrality and financial stability, offers a safe environment for investors. During financial crises, such as the Eurozone debt crisis in 2009 and the global financial crisis in 2008, many investors migrated their assets to the Swiss franc, boosting its appreciation. Furthermore, the Swiss franc has been a valuable asset for international trade, as demonstrated by the use of the Swiss franc in commercial transactions between countries in situations of sanctions or instability. 2. Pound sterling, GBP. The British pound is another currency that often serves as a safe haven during times of crisis. The United Kingdom, despite its own economic fluctuations, has a currency with a long history of stability. The British pound is particularly valued by investors in emerging markets and in situations of regional instability, offering a reliable alternative to the US dollar. 3. Chinese yuan, CNY. The Chinese yuan has been gaining prominence as an emerging safe haven currency, especially as China establishes itself as a global economic powerhouse. China's growing economic influence and its ability to manage its own economy with robust monetary policies make the yuan an attractive option for investors seeking diversification. Furthermore, the yuan has been used in international transactions, especially after the sanctions imposed on international financial markets, expanding its role as a safe haven currency. 4. Sovereign guarantees. Sovereign guarantees are widely recognized as one of the safest forms of investment, providing an additional layer of security and stability. These investments are backed by the government's ability to pay its debts, making them an attractive option for investors seeking security and stable income. Let's explore in detail what sovereign guarantees are, how they work, and why they are a popular choice for capital preservation. The concept of sovereign guarantees. Since the abolition of the gold standard in 1971, fiat currencies such as the US dollar and euro are no longer directly backed by physical assets such as gold. Instead, their value is guaranteed by trust in the government that issues them. Sovereign guarantees refer to investments in securities issued by governments such as treasury bills, notes, and bonds. These bonds are considered extremely safe because, in theory, governments have the power to impose taxes and create money to meet their debt obligations. Types of sovereign bonds. The main types of sovereign bonds include 1. Treasury bonds, bills, notes, and bonds. In the United States, Treasury bonds are issued by the Treasury Department and include three main categories: O Treasury bills, T-bills. These are short-term securities with maturities ranging from a few days to 1 year. They are sold at a price lower than face value and do not pay regular interest, but rather a full amount at maturity. O Treasury notes, T-notes. These are medium-term securities with maturities ranging from 2 to 10 years. They pay interest every 6 months and return the face amount on the due date. O Treasury bonds, T-bonds. These are long-term bonds with maturities ranging from 10 to 30 years. Like T-notes, they pay semi-annual interest and return the face value on the maturity date. 2. Municipal bonds. Issued by state and local governments, municipal bonds finance public projects such as infrastructure and community services. They offer tax advantages such as exemption from federal and sometimes state taxes. 3. Government-backed corporate debt securities. Some corporate bonds have implicit or explicit government guarantees, such as government-backed mortgage bonds or those issued by government entities such as Fannie Mae and Freddie Mac in the US. 5. Value stocks and mutual funds. Investing in stocks and mutual funds is a key strategy for building long-term wealth. Value stocks and mutual funds, in particular, offer an efficient way to achieve capital growth and generate passive income. Both are important tools for diversification and protection against market volatility, but each has distinct characteristics that can suit different investor profiles. Let's explore in detail what value stocks and mutual funds are, how they work, and why they are valuable choices for investors. Value stocks. Investing in undervalued companies. Value stocks are those that trade at prices lower than their intrinsic value as assessed by financial metrics such as price to earnings, PE, and book value. These stocks generally belong to companies that, despite having solid fundamentals and growth prospects, are temporarily out of favor in the market or face temporary difficulties that affect their share price. Investing in value stocks can be a profitable strategy, especially if the company recovers and the market recognizes its true value. Characteristics of value stocks. Priced below intrinsic value. Value stocks are often purchased when they are undervalued relative to their true value based on financial fundamentals and growth potential. Consistent dividends. Many value stocks pay regular dividends, providing a source of passive income for investors. Lower volatility. Although not without risk, value stocks are generally less volatile than growth stocks, offering greater stability during periods of market turbulence. Examples of value stocks. Established companies in mature sectors, such as consumer goods, utilities, and industrial sectors, are often good candidates for value stocks. Companies like Coca-Cola and Johnson & Johnson are often cited as examples of value stocks due to their financial stability and dividend history. 6. Real estate and land. The collectibles market offers a unique and potentially lucrative form of diversification for investors. Collectibles such as vintage cars, rare works of art, and other valuables have attracted the attention of investors and enthusiasts due to their ability to appreciate significantly over time. Although often considered alternative investments, collectibles can provide impressive returns and serve as a secure store of value. Let's explore in detail what makes collectibles an attractive asset class and how you can benefit from this market. The value of collectibles are items that have significant value due to their rarity, condition, and historical or cultural relevance. Unlike traditional financial assets, the value of collectibles is often linked to their uniqueness and demand among collectors and investors. These items may include vintage cars. Old and rare cars, such as the Ferrari 250 GTO or the Mercedes-Benz 300 SLR, are highly valued in the collectibles market. Not only do these vehicles represent a piece of automotive history, they also have an aesthetic and historic appeal that increases their value. They are valued not only for their quality and performance, but also for their rarity and impeccable condition. Rare art. Works of art by renowned artists, such as Leonardo da Vinci, Van Gogh, or Picasso, can reach exorbitant values at auctions and specialized markets. Art is valued for its historical importance, aesthetics, and the artist's reputation. Additionally, works of art can serve as a store of value, especially in times of economic uncertainty where their appreciation can outpace inflation. Luxury and limited edition items. Items such as designer handbags, limited edition watches, and special edition books can also be highly valued. These items often gain in value over time due to their limited production and demand among collectors and enthusiasts. Why invest in collectibles? Investing in collectibles can offer several advantages and opportunities. Appreciation potential. Collectibles can experience significant appreciation in value, especially if they are rare and sought after. The value of a vintage car, famous work of art, or luxury item can increase substantially over the years. Portfolio diversification. Adding collectibles to your portfolio can provide additional diversification, as the collectibles market often behaves differently than traditional financial markets. This can help reduce overall portfolio risk and provide a hedge against volatility in financial markets. Cultural and historical appreciation. Investing in collectibles can also provide a sense of cultural and historical connection. Owning a renowned piece of art or a classic car is more than an investment. It is a way of maintaining and valuing cultural and historical heritage.